This Chapter 1 introduces conduits in a general way. The chapter analyzes the structure of a traditional asset-backed commercial paper conduit, often referred to as a multi-seller vehicle, whose primary purpose is to purchase trade receivables from a bank's customers. We will examine the pooling process of the receivables and the determination of eligibility criteria for their inclusion in the transaction, the determination of the pool level credit enhancement needed to raise the pool credit quality up to the minimum standard required for their inclusion in the conduit, the sale of the receivables to the conduit, the issuance by the conduit of short-term commercial paper to fund its purchase of the receivables, and the measures taken to ensure that the conduit has sufficient access to liquidity in case the short-term funding market refuses to roll over the conduit's debt. We begin by considering the case of an electricity company that generates monthly accounts receivable from its retail and corporate customers with the characteristics described in this table. The aggregate pool size, $125 million. Total number of customers or obligors in the pool, 1 million, from which it follows that the average exposure per obligor is $125. Each obligor is granted payment terms of 30 days from the time the invoice is issued. The average delinquency rate for the pool historically has been 3%, delinquency generally being defined to mean failure to make a payment on time. The average historical monthly write-off percentage for the pool, where total loss is declared on a receivable, has been 0.5%. The three largest obligors in the pool represent individually 0.25% each, presumably some of the corporate customers. And finally, the worst historical monthly write-off percentage has been 2%. Given the high credit quality and payment experience of this receivables pool, the company could presumably raise significant sums of money by borrowing against the pool and pledging the receivables and their cash flows as collateral for the loan. The lender would logically be reluctant to lend the full $125 million face value against the pool, knowing that some minimum level of defaults can be expected to occur, and so would insist on what we call a haircut, i.e. a reduction in the principal amount of the loan that reflects, at a minimum, the average write-off expectation of 0.5%, in addition to the time value of money, since the receivables will not turn into cash for another 30 days. A more cautious lender might even set the haircut to reflect some multiple of the recent write-off experience, or even perhaps the worst case scenario mentioned previously, in which up to 2% of the pool is written off under very bad macroeconomic conditions. This cautious lender might also impose eligibility criteria, i.e. restrictions, on some receivables or some customers that might perhaps include restrictions on receivables already past their due date, restrictions on receivables whose enforceability may be uncertain, due perhaps to a dispute between the company and the relevant customer, or possibly exclude altogether obligors, i.e. customers, that failed to meet designated criteria intended to increase the lender's comfort level regarding their ability and willingness to pay their obligations in full. Either way, this kind of pool, with its highly predictable cash flow stream and its short tenor, is eminently capable of being financed using normal bank financing methods, such as a traditional short-term working capital loan. One key problem under the traditional loan structure is that the bank would need to book an asset on its balance sheet against which it will have to allocate some amount of regulatory capital. And quite probably the bank would also reduce to some degree the available credit lines it has to the company, even though the bank is looking primarily to the obligors in the pool for repayment. From the company's perspective, the company would have to report a liability which would inflate its balance sheet and make its various financial ratios appear worse, such as its leverage and debt service ratios. This could become a problem for the company for a number of reasons, such as the monitoring of loan covenants and various other important criteria. Around the early 80s, a new structure was developed for financing the pool of receivables while avoiding the generation of assets onto the bank's balance sheet, as well as debt in the liability measures of the company. Under the new structure, the bank first establishes a special purpose vehicle owned by an independent third party, raises short-term funds for the SPV in the commercial paper, and offers to have the SPV purchase the pool of receivables instead of making a loan against them. We assume that the SPV conservatively applies a 4% haircut to the receivables, and so purchases them for a price of $120 million, as shown in the parentheses. In fact, rating agency criteria generally mean that many programs set this haircut at the higher of either 3 times the recent write-off experience of the pool, or the sum of the 3 largest individual obligor exposures. The simple diagram you see here summarizes what we have described so far. The reference to transaction-specific credit enhancement in the box at the top of the page is to the haircut applied to the receivables pool to calculate the price paid by the SPV. Assume the SPV has promised a 6% annualized yield on the 30-day commercial paper it has issued, and that it has therefore netted proceeds from the issuance of $120 million, which it passes on to the company in return for acquiring the pool of receivables. Assume also that the pool experiences a write-off rate of 1.6%, i.e. worse than average, but still not as bad as the worst-case precedent. We can describe the allocation of the cash collected from the customers quite simply. The pool generates cash of $125 million times 98.4%, which reflects the 1.6% write-off rate, i.e. $123 million net. Note holders receive $120.6 million, which reflects their principal and interest at 6% for 1 month. And the remaining $2.4 million are remitted to the seller since they are not needed for any other purpose. We have, of course, omitted to take account of a number of other costs, which are normally taken out of the collections as well. Legal and administration fees for the SPV, dealer costs for issuing the commercial paper, rating agency fees for rating the CP and the program generally, accountants' fees, and so on. We will continue to ignore these throughout the module for the sake of simplicity, but you should recognize that in reality they do exist and should be treated in aggregate as another cost item that needs to be covered either from the cash collections or from the fees earned by the sponsor for establishing the program. The next evolution in the development of conduits stemmed from recognition of two important realities. First, that the electricity company would be generating new receivables on a monthly basis and would presumably like to continue selling those into the conduit under some kind of revolving purchase facility. And second, that the conduit should be able to purchase pools of receivables from a variety of sellers in different industries and geographies to increase the diversity of its assets and to immunize itself as much as possible against the risk of a major downturn in the fortunes of any one particular industry, so long as no pool carries a significantly worse aggregate credit risk than the others. Therefore, the single seller, single pool SPV turned into a multi-seller revolving purchase SPV arrangement, bringing us closer to how the multi-seller conduits actually function today. Our earlier structure can now be amended to reflect three major additional features, which are described next. Feature number 1. Under this feature, the SPV issues new commercial paper each time the previous series matures, uses the proceeds of the new issuance to repay the principal of the maturing tranche, uses some of the cash it has collected from the receivables to service the interest owed on the CP that has just matured, and remits the remaining cash in the SPV back to the seller in return for a sale by the seller of the newly generated pool to replace the one whose cash collections have just been received. If the size of the pool is increasing due to growing demand for electricity or seasonal fluctuations, the size of the CP issuance would similarly need to be increased. We illustrate this with an example extended from the previous one. We suppose the new pool that has just been generated has grown in size to 150 million due to a seasonal increase in demand for electricity. Other variables, such as the 6% yield on the CP, the three largest obligor concentrations, and the 4% haircut required by the conduit, are assumed to have remained unchanged. The SPV is now able to offer a purchase price for this new pool equal to 144 million, which is the 150 million face value minus the 4% haircut. To fund this purchase, the SPV now issues commercial paper whose net proceeds are 144 million and which is redeemed 1 month later for $144.72 million, reflecting the 6% yield for 1 month. If the write-off rate experienced by the pool has remained at 1.6% as before, the cash allocation from collections would now proceed as follows. The pool generates cash in aggregate of 150 million times 98.4%, which is the 100% minus the 1.6% write-off rate, hence 147.6 million. The note holders receive 144.72 million, as explained before, and the remaining 2.88 million is remitted to the seller, since it is not needed for any other purpose. The process can, in principle, continue indefinitely, with the amount of funding moving up and down depending on seasonal variations in the pool size and reflecting changes in the write-off rates, or in interest rates, or in obligor concentrations. In fact, conduits usually feature what is called a dynamic credit enhancement formula, which adjusts the haircut applied to the purchase price to reflect changes in the write-off levels of the pool as well as the other factors. If, for example, the pool continued to experience unusually high write-off rates, the haircut for the next purchase would be adjusted to an amount, for example, equal to 4 times the most recent write-off levels rather than 4 times the historical average, as we had done before, and vice versa if the performance of the pool were to improve. The second major change introduced was to permit several sellers, in fact several dozens of sellers in the case of the largest programs, to access one and the same conduit, in order to minimize administration and other costs, and also to improve credit diversification at the aggregate level for the SPV. This works quite simply by having eligible pools from different sellers sold serially or sequentially into the SPV with matching issuances of commercial paper for each pool. While the various pools are owned by one single SPV, issuing a whole series of commercial paper at different times for different maturities and in different amounts, there is typically no cross-collateralization applied across the different series and pools. In other words, if the write-off rate for the electricity company exceeds the haircut and therefore results in insufficient cash flow to redeem the matching commercial paper, while another pool from the telephone company, let's say, has cash in excess of its needs, the excess cash from the telephone company's pool cannot be made available to cover the excess losses of the electricity company's pool. This would simply be commercially unacceptable to the various sellers, who are, after all, independent of each other and naturally unwilling to assume any risk of loss from pools that they have not originated themselves. This reality, in turn, leads to the third feature common in all multi-seller vehicles, a feature known as the program-wide credit enhancement, or PWCE. The need for the PWCE stems from the sponsor's desire to obtain the highest possible credit rating for the commercial paper. Although there may be some probability that one or two of the pools purchased by the SPV may experience write-offs that exceed their haircuts, it would presumably be very unlikely for all the pools to exceed their haircuts at the same time. To the extent a limited number of pools suffer write-offs in excess of their haircuts, the PWCE is available to absorb those additional losses and therefore to shield the CP note holders from them. We illustrate how the PWCE might work by assuming that 10 pools of $100 million each have been sold into the conduit, that the PWCE has been set at 5% of the total program size, i.e. $50 million, and that the haircut for each pool is 5%. Assume now that 5 of the pools in the conduit experience write-offs of 8% each, i.e. $8 million per pool. The excess write-offs that are not covered by the individual haircuts are therefore $3 million per pool, or $15 million in aggregate. It is this excess that the PWCE absorbs, and having been set at $50 million, the PWCE is obviously more than sufficient for this purpose. The table here reveals the various combinations of excess write-offs and number of pools exceeding their haircuts that together would wipe out the PWCE entirely and leave the CP note holders exposed. it will be readily seen that these various combinations, shown in red, are very improbable, presumably consistent with the highest available credit rating for the CP. You should have no difficulty confirming the accuracy of this table, but we will help you by illustrating the entry in the cell in red, representing the case of 6 pools, shown at the top, each exceeding its haircut by 9%, shown on the left. Quite simply, the excess in each pool of 9%, when multiplied by 6 pools, gives a total excess loss of $54 million, remembering that each pool has a size of $100 million. The PWCE stands at only $50 million, and therefore is insufficient in this case to absorb all these excess losses. If, however, only 5 pools had experienced the 9% excess loss, the total losses now would have come to only $45 million, so the PWCE would have just about sufficed to absorb these losses and to protect the CP holders. Hence the coloring of that cell in blue. The PWCE can take any number of forms, ranging from cash collateral deposited by the sponsor of the conduit in escrow, to a guarantee or letter of credit or insurance policy provided by a highly rated third party, to sometimes the subordination of some additional investors in the conduit below the CP note holders. The introduction of the PWCE risk layer, in whatever form it takes, means in effect that the aggregate risk of the pools has been tranched, i.e. divided, into 3 layers, with each seller, via the haircut applied to its pool, absorbing risk first, the PWCE absorbing risk next, and the CP note holders absorbing risk last. This is a typical illustration of the tranching technology used frequently in securitizations and discussed extensively in some of our other modules. 2 final features of multi-seller vehicles we will discuss here are the liquidity support and later the use of hedging instruments. This slide focuses on liquidity support. In the ordinary course of business, we have seen that repayment of maturing CP is effected through the issuance of a new series of CP, with proceeds from the new issuance allocated primarily to the repayment of the maturing series. This, of course, assumes that the CP market will always be open for business and willing to purchase the conduit's short-term debt at some price or other. Unfortunately, the risk always exists that the CP market may experience either a general disruption, i.e., one in which all issuers are shut out of that market altogether due to some systemic event affecting all participants. Or alternatively, that the particular issuer may become unwelcome in the market, due perhaps to knowledge that its pools are experiencing unusually high levels of losses, or that the sellers behind it are experiencing significant credit downgrades, or for various other reasons. This risk has been addressed by the rating agencies by requiring for the great majority of multiseller vehicles that they obtain committed backstop lines of credit from highly rated banks that would be available to replace the maturing CP in case it cannot be refinanced with new CP in an aggregate amount equal to 100% of all commercial paper series the Conduit has issued. Quite simply, the banks providing the liquidity backstop stand ready to lend money to the Conduit, in essence stepping into the shoes of the recalcitrant CP note holders, until such time as the CP market is once again willing to provide financing to the Conduit, but only to the extent of the performing receivables. The banks, of course, charge a commitment fee for this service, and also a spread over LIBOR once their lines are drawn. And in any event, the banks do not feel they are incurring much risk, since, as we just mentioned, their contract with the Conduit does not typically permit the Conduit to access funds in excess of the amount of fully performing receivables, i.e. those that are not in default or delinquent or are in violation of one of the conditions for eligibility into the program, for example. This is an important point. We have seen that the haircuts and the PWCE are available to absorb credit problems affecting the receivables. The backstop liquidity lines from the bank are not typically intended to supplement the program's credit enhancement features, but only its liquidity. This important distinction, as we shall see, served to generate for the banks an acceptable return on regulatory capital, even when the fees charged for the backstop lines were quite modest. With regard to the use of hedging instruments, it is not uncommon for MSVs, multiseller vehicles, especially in Europe, to purchase receivables denominated in several different currencies, while issuing CP principally in US dollars and euros. This exposes the Conduit to FX risk, which is addressed through the purchase of FX forwards or cross-currency swaps. Thus, for example, a Conduit purchasing Swiss franc denominated receivables but issuing CP only in US dollars would also need to enter a forward contract with a highly rated entity under which it sells the Swiss franc against US dollars, essentially eliminating its exposure to changes in the dollar-Swiss franc exchange rate. Occasionally, the SPV also purchases receivables that earn interest based on an index, such as LIBOR, and therefore finds itself exposed to the basis, as it is called, between the LIBOR rate and the commercial paper rate. This risk can be eliminated through the use of basis swaps, in which the SPV pays LIBOR on a specified notional amount and receives the CP rate plus or minus a spread. FX forwards, cross-currency swaps, and basis swaps are discussed extensively in several of our other modules. We are now able to complete our previous diagram by adding into the picture the multiple sellers on the left, the PWCE at the top in the middle, the liquidity enhancement at the bottom left, and the use of hedging instruments at the bottom right.